Hello and welcome to the latest edition of our Fixed Interest podcast series. My name's Ed Parker. I'm the head of sovereign research at Fitch Ratings. I'm joined today by Brian Coulton, Fitch's chief economist. In this episode, we'll be discussing the latest edition of Fitch's Global Economic Outlook. Brian, perhaps you can kick off the discussion by talking through the main messages from your latest forecasts. And given it's been a few weeks since you published the June GEO, have there been any big surprises in the data release in SAT that you want to flag to listeners? We can then hone in on some of the issues in a bit more detail, particularly the outlook for rates, which is a key focus of this GEO.
Yeah, thanks, Ed. I guess I would say sort of four main messages to take away from this quarterly forecast report. The first is that the US economy is clearly slowing down now. It's not something that's surprised us. We see the fiscal support for the economy fading. We see the unusual boost from net trade last year is not continuing, and still some lagged effects from last 2 years tightening to come through. But that slowdown does not look dramatic. We're still sticking with our forecast of growth averaging 2.1% this year. We haven't changed that in this edition of the GEO. It doesn't look as if the consumer is suddenly going to fall off a cliff, but it definitely is slowing down. I think the second message is that the European economy looks to be past the worst. As some of the earlier adverse shocks start to fade. That's a pretty important development. Not necessarily big changes in our numbers there, but we're getting more confident in that view. The third message is that although we've upgraded our forecast for China's growth, that's partly an arithmetic follow through from the better first quarter, we're still pretty concerned about the domestic economy there and the deflation pressures. And then finally, while it's pretty clear that we do believe we're entering a new phase of global monetary policy where the major central banks are going to be cutting rates gradually. So it's a big shift, but we still don't think you're going to get much support to growth from policy easing in 2025. Interest rates are still going to remain in a restrictive territory. And then finally, just on your question about news flow since the last GEO, not that much to report really in terms of surprises on the activity front. I think probably the most significant development is following the better May CPI data for the US. We've had a decent PCE inflation print as well. So I think that's something that's going to help the Fed. And we also had the June labour market release, which showed wage growth continuing to cool. So I think both of those are helpful for the view that inflation pressures continuing to ease, albeit gradually, and support our view of 2 Fed rate cuts this year. So yeah, I think those are the main takeaways I would emphasize.
Let's start then on the European growth outlook. There's often a lot of pessimism about Europe's growth prospects, but it sounds as though you're quite a bit more confident, at least in terms of the cyclical recovery. So what lies behind that view, and how significant is that in terms of a turning point for sentiment?
Yeah, I mean, we haven't made a really big change to our forecast. We've raised the growth forecast of the Eurozone by 0.2. We're also more optimistic for the UK forecast as well. Not massive revisions to the actual forecast, but I think we're a lot more confident now that the recovery is starting to take shape. And you've got to remember the context here has been almost 2 years of stagnation in the European economy. And I'm talking more generally about the Eurozone and the UK combined. And I think part of what's going on is that the earlier adverse shocks that hit demand and activity in Europe are just fading away. A very important one, of course, is the terms of trade shock, second half of 2022, that pushed up import prices relative to export prices. That's almost completely reversed now in the Eurozone. The terms of trade is back to where it was before the Russian invasion of Ukraine. And that adverse terms of trade shock was something that hit consumers and corporate real incomes in the Eurozone very, very hard. And it was also a big negative factor in the UK as well. So the reversal of that terms of trade shock, I think, is pretty important. And we saw lots of evidence through second half of 2023 that the Eurozone economy was struggling from this energy price shock with that massive increase in gas prices. We saw the industrial sector in Germany, parts of that industrial sector that are most exposed to energy, chemicals, etc., were really struggling. But of late, we started to see energy-intensive industrial production in Germany recover. So I think that's evidence that things are improving. The other development, and this is kind of related in a way, is the turnaround in the real wage cycle. So we've got pretty strong growth in nominal wages in the Eurozone, but headline inflation has fallen back quite sharply. So there's a lot of real pretty decent expansion in real wages going on, and that's going to help real labour income. And when we do a comparison of what drives consumer spending in the Eurozone relative to the US, for instance, in the US, the saving ratio is a lot more volatile. So you have to think a lot more about consumer behaviour, and are consumers prepared to take on more debt, draw down their savings. In the Eurozone, it seems to be that ratio is a lot more stable. It's much more about the income dynamics. So this improvement in real wages in the context of employment still growing sends a pretty decent signal out about real household sector income. And if you look at household balance sheets, they look pretty strong. There's no real reason why you would need a further increase in the saving ratio. They went up in the pandemic, come back down a little bit, but have not fallen below their pre-pandemic rates. So there's a pretty important cushion there on the financial side. So I think that's an important part of the story, this pickup in real wage growth, supporting labour income, which will support the consumer increasingly over the second half of the year. We've not seen it in the numbers yet. It wasn't really there in Q1, but we think as Q2 and Q3 numbers get published, we will see a better consumer outlook emerging.
In contrast, the downside risks hanging over China's growth outlook seem to be mounting, with the property sector yet to stabilise, a challenging shift in growth model underway, and potentially powerful deflationary forces at work. Yet we're still forecasting GDP growth of 4.8% this year and 4.5% next. So how do you weigh up all those factors?
Yeah, I think what has surprised us on the positive side in China has been the external side. So we've seen a really big pickup in export volume growth in the last 6 months that we didn't anticipate. I don't think anybody anticipated. And for a large economy, China is very open. So exports are a pretty sizable chunk of GDP, much bigger, say, than the US or even the Eurozone as a whole if you do it on a consolidated basis. So I think that's something that has pulled aggregate growth up, and you can see the knock-on benefits of that in the domestic producer side. So industrial production has been a bit better as well. But as that external picture has improved, I think if anything, it looks to us as if the domestic demand drivers are getting worse. So we're seeing credit growth continuing to slow. We've seen property sales and starts completely fail to stabilize. We'd expected the falls to get smaller in absolute terms, and that's just not happening. And Fitch has revised its forecast for housing sales down quite substantially in the last few months. So property is not stabilizing. It's not a question of it not recovering. It's just not stabilizing. And given how important that sector is, there are pretty big knock-on impacts elsewhere. Lots of initiatives announced on property, but that don't seem to be really making a difference. And it looks to us anyway as if we've got this problem of the sort of the whole pre-sales model of how new houses are purchased in China, 80% being purchased off plan. That model is just broken. Households are not prepared to put money up front and give it to private developers because so many of them are in trouble. So these policy easing towards that sector is just not working. And if you want to, you don't have to look very hard to see the knock-on impacts of that on the rest of the economy. The consumer is really in the doldrums. Really very, very weak consumer confidence figures. Retail sales numbers improved a little bit in the first quarter of the year, but latest numbers have weakened again. So the consumer's flat on its back. Property continues to shrink. If it wasn't for exports, and if it wasn't for an expansion in the government's own deficit, which is, as you know, sovereign analysis, quite unusual for the government to be using its own balance sheet and its own budget, but that's what they're resorting to. If it wasn't for that, this economy would be a lot weaker. So it's true we've revised up our numbers in this edition, but the sort of the fundamental drivers of private sector domestic demand still look quite weak to us. And the deeper the economy gets stuck in deflation, the more I worry about the spillovers there. So, we've got prices falling in lots and lots of different measures are showing that pattern. So the GDP deflator, the broader measure, the export deflator, investment deflator, house prices, all of these are in negative year-on-year territory and have been there for quite some time. I mean, I think that's a concern. So when we're looking at the nominal growth numbers and when we're looking at private domestic demand, we're actually, if anything, getting a little bit more worried about the economy.
Let's turn to the outlook for interest rates. At the last Fed meeting, there was a shift in the dot plot from two to just one policy rate cut this year. But in the GEO, you're predicting two. So can you walk us through your thinking there?
A lot was made of this revision in the dot plot. I guess my key point I would make on that is that I don't think the dot plot is necessarily a great guide to what's actually going to happen to the Fed policy, and even Chair Powell kind of distances himself quite a lot from the dot plot. I think it's all going to be about the data flow, and our assessment about the data is that although inflation is proving sticky in the first 4 months of this year, inflation momentum went in the wrong direction, and that's what caused this sort of change in the Fed messaging. With the market anticipating at the start of the year the Fed would be cutting rates pretty quickly. That was never our view, and it was the data that came out for the first 4 months of the year that kind of led to that big change in the Fed's messaging. But the latest CPI print, as I mentioned, for May was quite a bit better. We had a pretty low core inflation print. That was then followed through on the PCE measure as well. So this super core measure of inflation that the Fed has flagged, services excluding rents, that's improved quite sharply on the latest PCE numbers. And then the payrolls data that we had for June, as I mentioned, showed wage growth on a 3-month basis falling back down to 3.5%. Now, 3.5% nominal wage growth is not that far above the sort of wage inflation that you would say was consistent with the Fed inflation target at 2, 1.25 for labour productivity. So I think as the evidence continues to show the labour market cooling, both the wage inflation data and the unemployment data, we think by September the Fed is going to be comfortable enough to start to take away some of the restrictiveness. They've obviously been cautious. They were right to be cautious on this earlier in the year, but I think the way the data is going, that's going to unlock a rate cut in September, and we think another one in December. And when we look at how the ECB justified their rate cut while core inflation was still above the target, they talked about, yes, we're starting to cut rates, but we're keeping rates at a restrictive level. They're still going to be tighter than what you would call a neutral level. I think the Fed will to some extent cut and paste that narrative, I think, when they make that cut in September.
Well, let's come on then to the ECB and the Bank of England and perhaps the monetary policy environment more broadly. In June, the ECB was the first of the world's major central banks to cut rates since the pandemic, but wage growth and services price inflation still look uncomfortably strong. So how many more cuts are you expecting from the ECB this year? And what about the Bank of England? And more generally, if the ECB has kick-started a new phase in the global monetary policy cycle, how do you see it unfolding in terms of speed and landing zone?
Yeah, we think the ECB will do 2 more rate cuts this year, but we don't think they'll be back to back. So we don't think they'll go in July. I think 2 rate cuts, one after the other, would be sending too strong a signal about the sort of path that they're on. But I think when they look at the overall inflation picture today, you can compare it with where it was, say, a year and a half ago. I think they feel that they can now start to take some credit for the decline that has happened. The goods part of the core inflation problem has pretty much gone away. It's now all about services. That is certainly not at a level that they would be comfortable with, but they don't need to get inflation all the way back to 2% for them to start cutting rates. They just need to be comfortable enough to start heading in that direction. They reached that point in June, and we think when you look at the level of core inflation or core inflation momentum in the Eurozone, it's quite a bit lower than in the US on a momentum basis. And we've been through a period of pretty low growth. We think that's going to improve, but we certainly don't see evidence that the inflation is going to start pushing up again sharply, unless we get some sort of global shock. So I think they will be comfortable with a couple more rate cuts. I think the Bank of England's got to start a little bit later. We've had the call for quite a long time now, since last September, that their first rate cut will be in August of this year. When we're looking at the wage numbers come off, we're looking at a number of indicators of the UK labour market starting to cool quite significantly. Again, we think the data will allow the bank to get confident enough to start cutting rates in August, and we have got 3 cuts penciled in. But we don't see rates coming down quickly through the next 12 to 18 months. And this is quite an interesting feature of the forecast that we just published is that although we've now got a sort of more broad-based easing cycle in place, and that's now kind of a reality rather than a forecast, and we're more confident in that turning point has been reached, we actually think the pace at which rates are coming down is going to be, if anything, a little bit slower than before. So if you look at where our forecasts for interest rates by the end of 2024 are now relative to the previous GEO published in March, we've actually revised up the level. So rates still coming down, but not coming down as fast. And in the US case, the rate cuts starting a bit later than we had been anticipating in the March GEO, when we thought that they would start to cut in July. So it's basically going to leave rates above neutral through the end of this year and through 2025. So it's going to be a fairly shallow path back towards a neutral rate, probably not till maybe even second half of 2026 that we think we'll get back to a neutral rate. And we think that rate is not going to be anything like the sorts of rates that we saw post-global financial crisis up until 2022.
Thanks, Brian, for your insights, and thank you all for listening. For more on Fitch's economic forecasts and analysis, please visit Fitch's website, fitchratings.com. We hope you join us for the next edition of Fixed Interests.